Okay? So there's been the 3%. Okay, so since 2007 to 2013, there's this 3% non-match, meaning there was a contribution to your account every month. But this year, in 2014, there's a difference. They started giving 2% in your account. If you are contributing into UMPIP, then they'll give an additional 1%. But if you are not participating in UMPIP, the other plan, the personal investment plan, then you only get 2%. So there's a difference starting 2014, the 6 months that we're talking about this year. Okay? And I'm hoping you're participating in UMPIP. At least 1% of your comp is into the account, then you get an additional 1%. So there's been a change in this program as well. Earlier in the defined benefit, the calculator, the multiplier has been changed. That's the same way here. We're encouraging everybody contribute into UMPIP. If you don't contribute, then you only get 2%.
I have a question for you.
Sure.
I'm missing something. This set of figures at the bottom is defined contribution.
No, the chart is defined benefit. Part 4, page 4.
Right, I saw that.
Yeah.
It's different than these figures.
Yes, definitely different. That's defined benefit. That's where we need to talk. That's it. You need to decide how much you're going to share with your spouse.
Okay, what's the second set of figures about?
The second figures is the one from this year.
Okay.
Remember, there's the earlier 2007 to 2013 and 2014 to the next 6 months.
And then on top of that, there's the
Defined contribution, yes.
So you can either take it as a lump sum or a roll.
Yes, the choices are you can take it as a lump sum, which is taxable. There's 20% withholding of that. Or you can postpone getting it, or you can do cash installment, meaning you can just tell us how much you want to get on a monthly basis. Or you can roll it over to another account to consolidate
I
it.
don't know whether you can handle this. I am going to see my tax accountant next week on some of this because I'm not too sure. It looks like a little more taxes than 20%.
What I'm talking about, the 20% is the lump sum.
Right, I understand it, but I'm wondering, in my case, if it doesn't need to be increased, and that's what I want to talk to them about.
That's why you talk to your tax advisor and say, I can postpone getting this money.
And then I found out, I took my UMPIP already,
Okay.
and that was at 20%, and then I forgot the state, I've got that covered now, but I think sometimes we forget that.
Yeah.
Still take the state.
Yeah, you have income. Yeah, this is all taxable. Income tax, federal income tax, and state. Unless you live in a state
So
that...
there wasn't a form from them for the state, there was just a form for the federal.
Federal. There's a form now for the
Yeah, I
state.
see that.
Yeah. Okay. So, defined contribution is pretty simple. It's really asking the question, do you want to receive the money or not? Because the amount is up there, and the choices are cash installment, lump sum, partial. So when you want to postpone to get it, you can. And later on, I'm going to show you another program called Life Stage Retirement Income, which can consolidate all of this defined contribution accounts. It can assist you to make sure that the money that you have on account can last you for a long time. The challenge of a defined contribution is because it's with the market conditions, you don't know how much you should be getting on a monthly basis, and you can outlive it because it's very easy to just take more than you need. And then by the time you need some money, it's gone. So life stage retirement income is coming up, which we're going to talk about in a few minutes. Questions about the CRSP, Clergy Retirement Security Program. So there's two choices here. You have defined benefit, meaning how much you're going to share with your spouse. And the other one, defined contribution, is whether you're going to postpone getting the money or you're going to get the money, or in ways like lump sum, partial, or cash installments. Okay? So that's the Clergy Retirement Security Program. Let's move on to the Pre-82, which most of you have. And this is where it's a little bit more complicated. MPP, the Ministerial Pension Plan, is a program that started in 1982 and ended in 2006. How this program came about is considered a defined contribution, meaning the church has been paying a percentage of your compensation into an account balance for you. And you see this account balance in your statement of account. Every quarter you see this. In 2008, that account balance became lower because of the recession. It has recouped now and hopefully will still continue to grow. And that's what you're hoping. By July 1st of this year, that money that you have on account is more because of interest. There's no more contributions. It ended a long time ago. It's just earnings now, okay? So let's, your Ministerial Pension Plan, that's the booklet. So what are you going to do? Well, it's an account balance. That means there's dollars there. This is real money. People think, yeah, that's not real. It's real money that you have. As of a certain date, remember the date that it's been created. As of this date, this is how much the account balance that you have. Well, the plan says, you know how much you have on account. You can't take them all out. You have to take 65% of it as a lifetime income, meaning for yourself and your spouse. The remaining 35%, you can take it out as a cash distribution or a lump sum distribution.
And pay the taxes.
Oh yes, you're going to pay taxes. Or you can do cash installment, which means whatever we give you per month, at the end of the year, we tell the government how much you took. So that's the decision here. It's really basically lifetime income and cash distribution.
I have a question. I'm not sure you can answer this, but why the 65-35 split?
Okay, that's a good question. Remember, this plan started in 1982 and ended in 2006. When I started the General Board of Pensions nearly 30 years ago, the whole account balance at that time, you can only take as an annuity, meaning you can't take any cash distribution. It was just given to you for your lifetime, and then when you die, your spouse gets it.
But that's no longer an option.
Yeah, no. And then let me continue. And then in 1998 or so, there was a clamor for, give us some cash. We don't have any house. We need some money for a housing deposit. We need some money. We've never had a house before. By the time we retire, we need some cash distribution. So at that time, they changed it to actually 25% can be taken out as a cash distribution. The remaining has to be an annuity. And then the recent, two general conferences ago in 2004 or 2008, that 25% became 35%. And then in 2012, there is no more choice of, can I change, because at that point you could still annuitize the whole account if you want to. But the General Conference said, no, we don't need the liability. Because of liability, lifetime income is a liability to your conference. As long as you're living, you are guaranteed this benefit. And then when your spouse, when you die, your spouse also gets the benefit. So if market conditions are not good, then they're on the hook for the money.
So even if your account is down to
No,
zero,
no.
the
No.
conferences or the general board are still paying?
No. When you retire, that money that you have on account will be deposited to this pool of money of everybody else, and that's where you get your pension every month. That money should be fully funded.
Okay.
Okay, that whole pool. So if that's not fully funded because of market conditions, the conferences all over the United States need to put the money into the account. And that happened in 2011 because of the market conditions.
Well, it also went back to the time when we had to do conference claimants in order to catch it up.
Yeah. But for now, let's not talk about bad experiences. For now, it's good. It's good, and we're going to hope for the best. Okay, so here it is. So this is 65% of your account should be annuitized, meaning for your lifetime, and the remaining 35%. And here's the application form. You can leave on account until age 70 and a half, meaning the 35%. or even this, if you don't want to do anything with this account, yes, you can leave it on it, because this is growing. This money that you have is growing because of market condition. So if you don't need any funds from this account of yours, you can leave it on account until age 70 and a half. By age 70 and a half, the government says, we need taxes. So you need to make a distribution. And it's not only us. Even in your IRA, you need to withdraw by 70 and a half, by age 70 and a half, because the only way the government can tax you is you need to take a distribution, so they know how much to tax you. So by 70 and a half, if you have forgotten that you have money on account at the general board, we will remind you. Okay, and you have to, if you take it, that means you have to annuitize 65% of it. And then the lifetime annuity is the same, similar to the CRSP defined benefit, 75, 85, 100. And then we're going to talk about this more lengthily now. Okay. And here's the 35%. If you want to take it as a distribution, you can roll it over to your UMP-IP account. You can take a cash distribution and use life stage retirement income, or leave an account or lump sum. Okay. When we talk about life annuity, how do we calculate this? We calculate this life annuity, your money, that's 65% that you have, will be calculated based on your age at retirement, your spouse age at retirement, the account balance that you have at retirement, the annuity that you select, meaning how much are you sharing with your spouse, more or less, and then the increase that you want to select as well, and then the mortality table, meaning we know how to project how long you're going to be living, and then the payout. Okay. So this is more complicated. There's 6 life annuities rather than 3 that we had in this CRSP defined benefit. And then the percentage annual increases. So here's where we're going to talk about this very, very clearly. Again, the same chart as what you saw earlier, right, in your defined benefit. So life with 70, life with 85, life with 100%. The way I tell participants is you read this from the bottom going up for yourself. Life in 70 is $1,284, but my spouse will only get $899 when I pass away. But if I want to increase and give her more, because I know she will need more money when I die, then it will be $1,239. It's less for me, but more for her. Right? This will be $1,053 from $899. And if I give really more to her, meaning 100%, that means I get only $1,196, which is so much different from $1,284. But she'll get more. Because when we talk about this, this is the beginning pension. Because there is an increase of automatically 2% annual increase. The calculation in your benefits is based on 2% annual increases. If you don't like that 2%, I'll tell you how you can change that, okay? So is this clear now? Again, how do you decide how much you should give your spouse? You have to think of the circumstances of your spouse by the time you pass away. First and foremost, your spouse doesn't have the housing exclusion anymore. That's only for retired clergy. So her taxes are going to be more, okay? The other thing is whether she has pension, whether she's going to be sicker at that time, whether she's got medical issues. So those information you need to take into account when you're deciding this thing.
And you're presupposing that our spouses will live longer than we do in every instance, and they may not.
That's true. But generally women do live longer than men.
I don't know, I pretty well made mine crazy.
Okay. Oh yeah, that's a good question. What happens if your spouse dies and then you remarry? Will your new spouse get a benefit? Question. That's a good question. Will your new spouse get this benefit when you die? No. Remember that moment in time, July 1st? Who is the spouse in July 1st? Okay? The same way, if you're single now and you want to marry somebody, marry that person before July 1st. Because who is that person? Who is the spouse at the time of retirement?
I have a question about beneficiaries. case of my husband and I, because we have a special needs son, we
Yeah.
set up a trust. Can the trust be the secondary beneficiary?
Okay, with life annuity, it's only 2 lifetimes.
Only two lifetimes?
This is an annuity. It's in the cash distribution that you can do it, but not with this.
Oh, and the other, okay.
This is an annuity, meaning lifetime only.
So for the other part, but not this.
Yeah, with the 35%, you can use that, but not this life annuity. Okay? So this is the issue about this life with joint life, sharing with the benefit. The other thing we can look at is this what we call life certain. Okay? If we look at, let's go back. 1551 for life only, meaning 1 lifetime. We're insuring 1 lifetime versus life with 70, we're insuring 2 lives. So it's actually more benefit to the clergy if you have only 1 lifetime. However, your spouse is not going to get anything upon your death. Okay? So if you want to do life only, she needs to sign off. She needs to know what she's signing, by the way, because that means she's giving her rights to say, I don't want a pension upon the death of my clergy spouse. And I have had this experience with a person in Wisconsin. The clergy died, and now the surviving spouse, is waiting for a pension. And so we did look at the records, and we had to show her a copy of the form completed by the 2 of them, to say, here's the form that you completed 10 years ago. You agreed to only have 1 life only. I think they were looking at the numbers. They were looking at, oh, it's a higher amount. Let's go with the higher amount. Not understanding that life only means only 1 lifetime. So make sure your spouse understands what these benefits are, because, yes?
I'm a little confused with the life, because I discussed it on myself. Sorry if you did. But I've been confused trying to read in the previous booklet and this one about what life with 10 years, life with...
Okay, I haven't finished that.
Okay.
We're just finished. I just did the life only. Okay, let's move on to life with 5-year, life with 10-year. The most important thing is the word life. Life only, 1 lifetime. Life with 5 years certain means with the next 5 years after my retirement, if something happens to me, I died on the 3rd year of my retirement, there's 2 years that's payable. So that means that 2 years can be paid out to your son, if you want it that way, or whoever you designate, okay? Because it's only for a period of time. The same way with the 10 years. 10 years is the next 10 years after retirement, in the possibility that I might die between the 1st year or the 5th year, then there's something payable. Because the number is higher, see? Because there's a sharing somewhere. And if you look at the other one, we're in, this is designated. You know that your spouse is going to get something. Here you don't know. Because if you outlive this 5 or 10 years, you go beyond 5 years, you go beyond 10 years, you'll still get the benefit because it's life.
So
But upon your death, nothing.
Life for you and a 10-year annuity
Yeah, it's kind of like
for your wife. Yeah.
for your wife. After,
Or the remaining
I'm a
amount.
little confused.
yeah, if you pass, if you live longer than 10 years, nothing's going to your spouse.
Right.
But you'll receive it as long as you're living. So most, and it's not going to go to your kids, okay? I'll give you a very good example how this is very clear. Eastern Pennsylvania is another conference I deal with. I meet with participants one-on-one. This woman came to me and she's divorced. And she said, what about my MPP? And so I gave her this form and I said, here's the choices. This is benefit for you given for your lifetime. And then she got mad at me. That's not fair. I said, what? That's not fair. I served for 30 years. My children should get something. And then I had to remind her, of course, that this is benefit given to clergy, not as an inheritance. Okay. And then she kind of calmed down and said, but you don't understand. I have cancer. I don't know how long I'm going to be living. And that's when we explored the issue about, well, you might want to choose life in 5 years or life in 10 years. In the event of your early passing, then your children can get something. Which made her better. Okay?
Everybody's circumstances are different.
Oh yeah, everyone's circumstances are different. That's why it's important that you understand these choices, because these choices will remain as long as you're living and as long as your spouse is living. Because this is considered life annuity.
Who determines years of service? Do you all or does it comment?
It's the conference.
I've always wondered why my first 4 years as a supply speaker appointed, and pensions and everything else was paid, but I don't get those years of service.
What plan, are we talking pre-82?
382.
Okay, pre-82, with regards to serving lay, deacon, part-time local pastor, student local pastor, that's a conference decision. The General Board of Pensions does not have anything to do with providing the benefit there. So,
Let me ask that question. What if we discourage them from paying the pension benefit?
what do we discourage?
It was part of our apportionments, is what I'm saying. That's why I don't understand how they determine this.
You have,
By that for a long time.
well, you need to talk to Trudy and other, because it's a choice. It's a choice of the conference who they, remember this is with pension credit, yes or no. So if they decide to give you pension credit, that needs to be approved by the clergy support team, and then also in your journal, has to be documented in your journal. Okay, so that decisions about the pension credit for pre-82 is always a conference decision, not the General Board. Because ultimately, who pays for it? It's the conference, not the General Board. We just administer the plan. Okay, question. So everyone's clear about what this means? Life only, life with 5 year, life with 10 year certain. It's the sharing of the benefit. How much you're going to share the benefit. As long as you're living, you have this benefit. Okay, the cost of living. This is where people's like, what does this mean if I have a cost of living? Well, let's look at the line across first. The zero increase, when you start at age 65, you get a higher benefit. About $2,000 or so, in this example. But it will never, never increase because it's a higher benefit already. You got the higher benefit, so it will just remain the same as long as, and this is where people call me and says, why did I get no increases? I voted at annual conference. I don't have an increase in my MPP. And then I have to say, well, that plan is different from the plan that we're talking about. Yeah, MPP Ministerial Pension Plan is based on your application form. It's not based on the conference decision. That's the pre-82 plan. So if it's 5,000, if your zero increase, that's the same, but you get the higher benefit in the beginning. If you get 2% increase, then it is at a lower benefit, the next one, which is the purple, lower than the 0 increase, but it gradually increases. If you get the 5% increase, which is the last one, you get a lower benefit first, because the increase is going to be higher substantially. So that's the decision you have to decide. Like, do you want an increase relative to, the norm, which is 2% right now, or you want a higher increase, which means I start at a lower number, but I get big increases. If you live long. That's the good question, if you live long. So that's really what it means. You have a higher increase, that means you start low. 0 increase, no increase. 0 increase meaning no increase, but you have a higher benefit. So in your packets is 2% increases. That's been calculated based on 2% increases. If you do not feel that that's right for you, or you want to know the numbers, then we have this benefits access application that you can go into. This is a new system that's been just available this year. Prior retirees never had this choice, this opportunity. So you need to go into our system, benefitsaccess.org. You need to register, and you can get this retirement tool. You can do beneficiary designations if you want, retirement readiness tool, and benefits projection. Okay, here's the form. Actually, when you go online in this Benefits Access retirement tool, you just need to change this bottom thing. What annual cost of living adjustment would you like? So once you change this number to 2 or 3, automatically the numbers change. So you would know what these numbers will mean to you. But if you're comfortable with the 2% increase that's there, then you don't need to do this. But in case you want to know, here it is.
I'm not sure I'm clear about this. The 2% is already built into the.
Yes, they're all built in there.
So whatever's here is forever.
Yes.
What we've done.
And right now, I think 2% is also built on the Social Security.
Everything's, yeah, built in. The calculation's built in. That means next year, you'll get an automatic 2% increase. Whatever you start with in July 1st,
You get a 2%.
you still get 2% increase
Oh,
next year.
there isn't one.
That's not the number. Remember, the number is based on the date.
Yes. But I'm on family, I'm not getting income, so for me, this is probably.
Yeah, that's so the MPP will be based on your numbers by July 1st, whatever that value is,
Yeah.
right? That value, that amount.
Yeah.
Pray Russia stays out of Ukraine.
Okay. So everybody's clear about this? You can get numbers in our system. And actually, this benefits access system, if you are comfortable electing your application, you could do it, and you don't need to send this form in. Now, but if you still want the form in, you can send it in, but you can certainly do that if you want to. So it's only for this plan. The others, you still need to submit the forms. This is MPP, Ministerial Pension Plan, the one that we're talking about right now. If you go online, it's the MPP annuity. So you can go in there and choose the application, the choice that you want, how much you're going to give your spouse, and also this cost of living increase. And then you've submitted the form. But if you want to do the form, you can. Yeah, it's actually my personal opinion is they should do all the forms or not one at a time. Yes, sir.
Probably if I read, I can answer my own question, but these forms need to be in by when?
These forms need to be in by 1 month before your retirement date, which is actually June 1st. And I'm going to tell you what that means in terms of when we get to the retirement. Okay, let's just talk about it now, just in case. Okay, what does that mean? Remember, I was telling you just the numbers are important, but those numbers really are not the numbers you're going to get, because those numbers were calculated based on the date it was made, okay? Okay, so you submit these forms to us, all the forms that you want. If you submit forms, that means you want to make a distribution. You want to get some money out. That's the reason why you're submitting these forms. If you don't submit the forms, that means you are comfortable not getting the money at this time, okay? That's the bottom line. So you submit the forms. So what we will do, and I'm making this simplistic, okay? What I understand is, what happens is, okay, for Reverend Parker, this is the form that we got for CRSP. His decision are this, spouse, cost of living. So that's programmed, whatever choice he made. MPP, this is the choice he made. You know, all the choices, whatever plan it says. So that's already programmed. By July 1st, a button is pushed because that decision has been made. So those forms just tells us how you want to get your distribution. If you don't submit it, then we won't give you a pension.
I have a question about the very last box on the MPP. It says, check here if you are rolling over.
Yes, that's the next part we're talking about. Okay, so this is all about the 65%. Remember the annuity, we're just talking about the annuity. Now we're going to go with the 35%. What are you going to do with the 35%? You have cash, and that's actually on page, on part 3. Yeah, part 3, is it part 3? Yeah, it tells you how much your 35% is. Oh, yeah.
The other form.
The other form, not that, not the rollover. Yeah, it's also in your, here. Dollar specific. Yeah, it tells you how much your 35% is. Oh, I'm looking at the UMPIP form. It tells you, see, I'm confused already. Just look at the forms. Different forms. We're looking at MPP. Okay, MPP form. So that's part 2 says your whole amount. And then on option 1, part 2, it tells you your 35%. So it's page 2, option 1. It tells you how much is your 35%. Page 3 is the annuity. That's 65%. So for the defined the MPP 35%, now, okay, you have an amount, that means that's the 35% of your, what will you do with it? Do you want to roll it over to your UMPIP account? Do you want to roll over to another insurance company? Do you want to get a distribution? Do you want a cash installment? So there's choices on what you want to do with this. Or you can leave it on account until you're 17 and a half or later when you need the money. Because it's taxable, 20% withholding if you take a lump sum. So with regards to this 35%, that's a choice. Now if you decide to roll it over, that means you have to complete this form. This says Ministerial Pension Plan Rollover Form.
Unless it goes into PIP.
Unless you want to do it into PIP. Yes.
Let's show you how many.
There's this form called rollover. If you want to, the 35% of your MPP, if you want to roll it over to another institution, you need to complete this form. But you need to tell us how you want the disposition of that fund.
Now, can you take a certain percentage out of that and have it taxed and roll the rest into life stage?
Yeah. Yes, you can. It's your money. You can do whatever you want with your money. That 35% is yours. If something happens to you, it goes to your heirs. It goes to your spouse. Annuity, though, it's based on 2 lifetimes. If the 2 of you pass away after a year, the benefit stops. It doesn't go to kids. Annuity is only based on lifetime. But the cash distribution DC account is always given to whoever the heirs are.
From what I can see, this is a very good investment.
Yeah,
And let's say I put this distribution of 30%, roll that into UMPIP.
Mm-hmm.
Do I also check the very last box on page 5, or is that only for outside institutions?
In order to roll over your distribution, check your, I think you have to sign it. You have to mark the box. It says any or any part of your distribution. I think you have to, because we'll know that that is your decision you want to roll.
Rolling it over.
Yeah, rolling over.
Thank you.
Okay? So that's why these 2 forms go hand in hand, the rollover form and the application form for MPP, because of that 35% that you're entitled to receive if you wish to receive it. Is that clear, MPP? So let's do a summary of MPP, the Ministerial Pension Plan. You have an account balance that's been accumulating. That will still grow until July. Okay, right now they have the amount for you based on the date it was created. Market conditions, the way it is, it should grow. If market conditions will go south, then it will go south. Okay, so at that point you can postpone getting it until later on. But in case you really need the funds, then by July 1st, you tell us how you're going to receive the money. The 65% needs to be given to you for your lifetime. And then you decide how much you're going to share it with your spouse. How much is he or she's going to get upon your passing, after your death. The 35% of the account balance is a choice for you whether you're going to get it now, postpone getting it later, or rolling it over to another account so that you consolidate everything. Or you can leave it on account, like, I don't want to deal with it right now. Yeah, you can. It's still invested in the market because that's how it's been for a while. Will it increase when you get next year? Yes, it will. The 35% can increase next year. The annuity can also increase if you postpone getting it because it's based on account balance, remember? So if you decide not to get your MPP now, the annuity, and later, you can do it. Of course, you're older at that time too. Yes.
Are we talking about UMPIP later?
Yes, we're going to talk
So
about
we'll
MPP.
get to those options for
Yes.
distribution later?
Yeah, we're going to talk about all the plans. Okay? All right. For those who have pre-82, the pre-82 plan is very simple. It's years of service with pension credit that that your conference pretty much decided to give you. Now, if you serve 3 or more conferences prior to 1982, then each conference will be different. Their past service rate will be different. If you were not just in Missouri, you were in Indiana or Illinois Rivers, those different amounts for that. Okay, what's the decision for pre-82? The decision for pre-82, which is one sheet of paper, just one sheet of paper. Part 3 says, I elect to begin my pension. I elect to defer my pension.
You're saying it's 2 pages?
No, 1 page.
I've got a signature page on the back.
Okay, it's probably signature page, but
Probably
yeah.
made it 2 pages.
Yeah, they made 2 pages for you.
They probably made it 2 pages instead of front back. or just
Okay.
front back.
So as long as it says supplement 1 to CRSP, the same form we're talking about. Okay? Supplement 1 to CRSP, that's the form we're talking about. So the choice is really should I get the benefit or not? If I want to get the benefit, then when? If I don't want to get it, then I have to tell I elect to defer it. Okay? And the question here is, what happens if I defer this? Will the benefit be the same or will the benefit increase? And the answer, it will not increase because the benefit is based on a formula. And the formula is based on the past service rate that you have right now, and then the years of service that you serve with pension credit in pre-82. Pre-82 is over. I mean, it's been gone. It's been done for a long time. So you increase there is only whether the past service rate is based on when you retire. So you retired this year. Whatever your past service rate this year is what you're going to get. And for Missouri, your past service rate is, I should remember this, but I didn't. 553. So for every year of service in pre-82 with pension credit, you have 553.
Are these figures locked in?
That's the one, yes. Yeah, for the pre-82, that's the number. You have the numbers there. So those are the two that's together.
Is there a booklet?
No, there's no booklet. You got it right. Okay. So here it is, defined benefit, formula benefit. It's based on how many years you have. Here, it's a lifetime benefit. The decision really is whether you're going to get it or not. It's based on whichever's higher. If you served 10 years, then you probably get about $553, $460 per month. The other one, the defined benefit service money, that's when you started. It could be higher for you. If it's higher, and it will tell you in the sheet what benefit you're going to share on the lower left hand, whether you're getting the defined benefit service money or the formula benefit.
One benefit based on DBSM?
DBSM? Yeah, that means you're getting the higher benefit. Okay? And the higher benefit means the red line, that's the higher benefit. It will not increase anymore.
I know this is a stupid question, is that life as well?
Yes, lifetime. And your spouse will get the benefit also. It's the conference that made this decision. It's 70%. So married participants, you have no, if you don't want to give this to your spouse, you have no choice. Actually, this conference said you have to give it to your spouse. Whoever the spouse is at the time of retirement. That's benefit paid for life. Pre-82. Very simple. Let's move on to UMPIP. That's what we were talking about earlier. UMPIP. UMPIP is the money that you put in on your based on your decision. before tax, after tax, rollover, if you rolled over money, IRA. So these are the monies you have contributed whenever you started UMPIP. So it's now, it's been earning based on how it's been invested. So the way you're going to get this is basically, do you want a cash distribution? When you do a cash distribution, do you want a lump sum, partial, cash installment, leave on account? Anytime something happens to you, it will go to your heirs. I always say this account makes the difference. UMPIP is your money to the last cent. If you and your spouse pass away, it will go always to your heirs. It will not go to my account or anyone's account, but your spouse, your beneficiaries. Okay, this is where we're going to talk about, again, benefits access. Benefits access is this, what we call the retirement tool. It's called retirement installment payment tool. Do it yourself. So we talked about defined contributions, meaning the money that you have accumulated as cash. So CRSPDC, defined contribution, right? Your 35% from MPP, your UMPIP is also a defined contribution account. So those accounts can be consolidated into one account in your name, and you can use this benefits installment payment tool. What is this tool? I'm very excited for this tool, and I'm sure Trudy is also excited for this tool. Because unlike you, lay people do not have lifetime annuity. We don't have that. So the benefit that we're going to get when we retire is based on our account balance, whatever we've got at the time we retire. And now it's going to be hard for us to figure out how it can last us for as long as we're living. You know, it's very easy to withdraw and withdraw. We buy a new car, you know, your children need this. So, well, how do we make sure that benefit, that money that we have on account can last us for as long as we're living? Well, this one will help us. It's the retirement income calculator, life stage retirement income calculator. So in the first box here, all the money is consolidated. It's all consolidated. MPP 35%, UMPIP, one account, DC account, one account. And then we're going to be asked, do you want to put something aside? Well, I don't know about you, but I want a lavish funeral. So I'm going to put away $25,000. So I'm going to take $25,000 away. I'm going to tell them to put away $25,000. And so they're going to put that aside. And then the recalculation will happen to say, okay, $25,000 less $25,000. $100,000 less 25, then that's what they've got, 75 now. And then when I want to start receiving the benefit, it will recalculate and it will give me monthly payments annually, and it will adjust for inflation automatically. It gives me an excellent chance that this can be a lifetime income, but no guarantee, okay? Because there is this payment safety zone that every year I'm going to be informed about. I'm going to get a letter in November saying, this is the payment zone that you can look at to say, between 540 and 1011, you can get some money based on current market conditions. That's the safety zone. So I can tell the general board, yeah, I want $600 per month. And then after the year is over, and by November, it will recalculate and do the calculation based on market conditions again, and inflation and stuff. And then it will give me another payment zone to tell me what I can pretty much decide on what to get. So it's like an annuity because it can give me an idea of how much money I can get, and it will help me stretch these funds for as long as I'm living. So this is a tool. So this is a tool for participants who have defined contribution accounts, and you have those defined contribution accounts. UMPIP, DC, the defined contribution for CRSP DC, UMPIP, and 35%. That's there. Okay? So yeah, you can be adjusted, and it could increase or decrease depending on market conditions. Yes, sir.
I think this tool is answering one of the questions I had. Basically, we'll be drawing money out of different funds, but my question was, how will we know what that total amount will be? That's this, is that it?
Mm-hmm.
Okay.
We'll tell you the payment zone, and you tell us how much you want to get. Hopefully between those two zones.
On those three sources,
Yeah, from those three sources.
which will be all in
Rolls them all
the
together.
UMPIP, and then they're drawing as the
Yeah.
market does, and you select.
You select which one you would, the amount that you're comfortable with.
Do we get all that in one check?
Yes. All your money, by the way, whichever plan it is one check. It goes to your, and I'm suggesting it goes to your account. Don't get a check, physical check. You want
Put them all the different ones together in one check.
one check.
Is it designated which is which?
No.
In the check? Okay.
If you want to itemize it, you have to call the general board and we'll send you a letter. But most of the time, we send the whole check to your savings account or say check. You know, and you have the form, the depository agreement form here to tell us which bank you want it to go to.
Don't they follow up with a breakdown in the mail?
No.
After they've deposited it? No, it's just, okay.
You can call and say, can you give me a breakdown, and we'll do that for you. But the idea here is you're retiring July 1st, and how many conferences retired July 1st? About 30. 30 of you, all the time, you retire about the same time, and I don't understand why you all meet at the same time too. That's why I have to split myself into 3 to go to all your annual conferences. But so what happens is, again, is when we get your forms back, the decisions you made in each of those forms will be programmed, and so it's automatic by July 1st. We press a button and everything is calculated the way you want it to be. And so the checks are sent out straight to your bank. You want to have your checks go to your bank because where you can go anywhere in the whole world and it's there. Versus a physical check, you know, it's always near February 4th. There's always a holiday.
I saw a form in here for direct deposit.
Yeah, that's it.
But your
Direct.
routing number and everything else.
Yeah, routing numbers and everything. That's what you need to complete as well. That's where I suggest.
Do we get a notification of the deposit, or is it just on our bank statement?
It'll be in your bank statement. Always first of the month. Okay, let me ask you, the question I'm going to pose here is, are you going to get, by July 1st, a check in your checking account or savings account? No.
Follows a month, doesn't it?
The answer is no. Why? Because there's 30 conferences retiring at all at the same time.
But probably sometime in July.
Oh yeah, you will get it in July, definitely. If we get delayed and we give it in August, then it's going to be 2 checks. But we usually are fine with giving it to you in July, but not July 1st.
But it will get caught up by August.
Oh yeah, it will get caught up.
Okay.
It will get caught up. It's all automatic. It's all computer generated. Yeah, it's all I know it's all computer generated. Everything's into computers now. So yes, my suggestion: make sure you complete the depository agreement form, which will be the form that will tell us where it's going to be sent. Okay. Well, this is the investment options. In case you want to leave your money on account, you don't want to get any distribution. These are still how it's invested in. We've been doing very well. We've been having a good returns. As of February 28, everything's been positive. I don't know, the last week or so we've been getting negative, so this is after 28. Okay, Life Stage Investment Management Service. In case you didn't know and you were not paying attention, this is the service that's being used to invest your money, especially your MPP money. MPP money is something that the General Board does for you, so it's through Life Stage and Management Service. And it really does a personalized investment management tool for you. We customize it based on your needs. And so we know you are this age. We know we have some assumptions, but we do know your age because of your birth dates on account. We do know your account balance. The risk tolerance, we assume you're a moderate risk tolerance, meaning you are okay. The market goes down now because tomorrow it's going to go up. However, if you are not that comfortable, with the market condition and you have low risk tolerance, then you have to tell us. It's okay if you have low risk tolerance. Some people have different, some people react to the market differently. But if you are just moderate, then we assume that. With Social Security, we assume you're going to receive Social Security benefits. Now, you have to tell us if you opted out of Social Security. And then the date of annuity, of course, when we assume you're going to get it by the time you retire. So all of these different factors for you are going to be put together to make this target allocation. So based on Reverend Parker, this should be the target allocation for his MPP account. 15% to this, domestic stock, stable value fund, 5 accounts there, 5 funds. Okay? If you call us and say, oh, by the way, I'm retiring at 72, then we will readjust this, because it means that you're going to be working longer. Or I will not have Social Security because I opted out. We will adjust this as well. But this is how we do the target allocation. So and when the market conditions are good or bad, it rebalances automatically, and it rebalances automatically when you have a birthday, because you're getting nearer to retirement. Okay?
Is the assumption made that we will automatically get Social Security benefits
Yes.
at the time of retirement?
Yes.
So since I'm not under any call, I have to be 66 to get full Social Security benefits.
We know your birth date, so we do know the normal retirement for Social Security.
Okay, and that's what it's based on?
Yeah.
So for me, it's-
Yeah,
Okay.
Social Security is based on your date of birth. So we do know. What I'm saying about Social Security is the people opted out of Social Security. So we don't know that. So if you've opted out of Social Security, you've never paid into Social Security, yes. So that means you have to tell us so that we will readjust that. But we do know your normal retirement based on Social Security. Okay, so this is before actual and after rebalancing. Automatically, the system, there's an algorithm. When the market conditions are very good, then it will sell. If the market conditions are bad, then it will buy stocks or bonds or anything that they need to do. The other service that we have is the Ernst & Young Financial Services. In case you're wondering what that's all about, this is a very confidential financial planners that we have hired at no charge to you. It's actually by phone, by telephone. It's a telephonic consultation. The good thing about this is they will not sell you anything, okay? There is no transaction fee or anything like that. You might have a financial planner already. It's very easy to get one. You go to the bank. There's always a financial planner in the bank or an insurance company, but they will always sell you a policy or open a bank account. So if you do have a financial planner, a real financial planner, I also suggest that make this as your second opinion. This is not going to cost you anything. All you need to do is complete some forms. And if you already did that before, you can just copy whatever you've done for your financial planner. The other thing too is if you have a hard time completing the forms, because what happens is you call them up and you say, I need this. And then they'll send you the forms to complete, because they need to know who you are, what are your hopes, what do you need to spend, your assets, expenses and all this stuff. And so they'll give you a retirement plan. And I've seen it. It's very, very nice looking. And then you can call them up at any time when your circumstances change. The other thing I always tell participants is you can call the same person, because there's going to be a staff of financial planners there. If something happens, there's a change in your financial situation, and you want to redo your estate planning or some sort, you can call them up and say, can you redo this? Call the same person, and they will do that for you. And these are the topics that you can...
I recommend it. I used it. In fact, they set an appointment for me to call them back.
Okay.
Spent about an hour and a half. Went over.
And you recommend it? Good.
And they're quick to send you information on what you went over.
Wonderful.
Life stages, stuff that all comes out within days.
That's what we want to hear, because we're paying them. Okay, so that's something that you can do since you have money on account. And even though you're retired and you have still money on account at the general board, you can still avail of this. Okay. Okay, the housing allowance exclusion. I'm sure you're dying to know what this is all about. Okay. This is actually, I said earlier, to minimize taxes. It's not to avoid taxation. And as a clergy, you have this privilege. But upon your death, this is not available to your spouse. So now that you're retired, you need to figure out this housing exclusion. You need to figure it out. Right now, well, as an active clergy, it's usually the church who says, this is how much you can designate. This time you don't have a church to tell you that. But you do have the conference to tell you what your housing exclusion is. And the conference is saying you can designate 100% of your pension from the general board. So that will include your monthly annuity, your withdrawal, if you perhaps took $50,000 out of your MPIP to buy a house, whatever you took out, that could be for that year. Because every year you have to do this, every year. And you need to keep records. Because if you get audited by the IRS, this is between you and the IRS, the General Board or Missouri Conference has nothing to do with this. Because you're the one that's calculating this. So when you're calculating this, you need to make sure you know these three things. First of all, amount designated. Well, the conference said 100% for your pension. So you do know what your total income is because we send you a 1099. The General Board's going to send you a 1099 next year to say, this is how much you got from the General Board, okay? Or any withdrawals that you got. But number 2 and 3, you have to do this yourself. Well, you need to figure out how much you actually spent for housing. So what are these housing expenses? Mortgage. I just bought a house. I have to pay mortgage. Interest, if that's something that you still have home interest in, and also the, what they call the points for that first year. Utilities. How much am I spending for my utilities? In the wintertime, how much am I spending for someone to, shovel my snow? Furnishings. Okay? Bought new house, I bought new furniture. Anything relating to housing. Lawn service. And number 3 is the fair rental value of the house. The house that you're living in, if you were going to rent it out fully furnished, how much is that going to be? How are you going to calculate that? Well, that's going to be hard. So you can call a realtor and say, if I rented this house of mine, how much would it be? Or you can look at your classified ads in the neighborhood to say, in here, this is how much it is. Pay this booklet called What You Need to Know About the Retirement Process, page 10X. You've got this sheet, which I suggest you make a copy of, and then you do this every year. Because this sheet pretty much itemizes the things you could use for housing expenses. X. It's actually page 10X. Roman numeral X. Yeah, it's what you need to know about the retirement process, the thick one. Okay? So it itemizes the things that you can use in terms of fair rental value of the house. All right, let's do some examples then. So a clergy person gets $24,000 in pension. That's what they got for an annuity for the whole year, $24,000. So because this is the first year, they spent $20,000 in housing. Probably renovated the house or whatever they did. Okay, $20,000 in housing. But the fair rental value of the home, of the community, where he or she's living, is about $21,000. So now you have to figure out which is the less of the 3. So it's $20,000, right? So the housing exclusion should be $20,000. So when you're doing your income tax now, what is your income? Your income is $24,000. You can exclude now $20,000. So that means what's payable in terms of taxes is only you have to figure out $4,000 as taxable income. Because you excluded $20,000. Yes, sir.
This is only pension and non-annuitized distribution funds.
This
In
is
other words,
pension that you got from the general board.
right, any funds you get from the general board.
Yes.
Okay.
That monthly check comes.
Yeah, Munchie is one of them.
Yeah.
But if you have pension from your other former job,
Yeah.
not included.
Not
So if you roll your non-annuitized funds over into another organization, they have to be kept separate then? Or do you lose that then?
The money that you had at the general board, you rolled it out?
Yep.
Okay, and now you're getting money from that account?
Yeah, let's say I roll it over
Yeah,
to Denver
I understand.
Jones.
I understand that. You can certainly take that, but you make sure
Don't
You-
commingle it with other funds.
yes, because what's going to happen is you get audited, you got to prove that that money that you put in Edward Jones was really from your pension
Very
plan.
good.
Yeah, that's why we
You'd rather
discourage,
did, yeah.
yeah, we discourage people not to take money out because it's very hard.
You talked about the 1099
1099, you get,
from the general conference.
general board will give you,
general board, and usually there's a place that, so do we have to tell them? I mean, there's usually a place that they put,
the furniture and everything, so probably this is just utilities. It's still, the value of the house is still 21,000. So now the income minus the less was 10,000. So the exclusion is 10,000. So you still have to pay now taxes on 14,000. Okay? The next question is, okay, you have a housing allowance of housing expenses 25,000. The value of your house is higher. So what's less, you can exclude whatever the less one is with 24,000. For this participant, 0 taxes. So every year now that you're retired, you need to do this. You need to put your receipts in order to say, okay, I have to justify that my housing expenses is 25,000 or whatever it is. And it is the least of the 3, and so I can exclude that. Because this is between you and the IRS. And this is the example here. It's available to clergy, not to surviving spouse. You put a note to the 1040. Yeah, when you do electronic, it's probably going to be hard, but they probably will know this. Yes, sir.
If I change addresses and the amount goes up or down, do I do anything about the allowance?
If you change addresses, depending on where you live, of course, yes.
If I move and my rent goes up, can I get more money?
Depending on when you calculate it. You have to figure out these things again. Every year, if you do half a year, then 6 months, yeah. So the first 6 months you're active, right? That's why some people say, I want to get my pension January 1st, because this is more confusing to me. Because you have to calculate this from July 1st to December, what your exclusion is. So wherever what time. Okay, for people who have 2 homes, because sometimes, we live in Florida for the summer, for the winter, and then you have to make sure you get this in line as well. How much will be my exclusion when I'm in Florida, and what's my exclusion when I'm in Missouri? Again,
Pretty sticky about second homes.
yeah, but usually it's got to be your primary home. So you just have to keep records. That's all it is. You got to keep records. If you get audited, it's between you and the IRS. Okay?
Question.
Yes, sir.
Okay, looking at this and saying that, okay, on my income tax, I'm taking the mortgage interest off.
Yeah, that's in your expenses.
Yeah, on my deductible expenses long form.
Yeah, you're going to double dip. Yep.
So that's my question, can I
Yes.
double dip?
Yes, you can.
Oh, bless you.
Yes, you can. That's the advantage of being clergy. You can double dip. Yep. I know you're itemized. Yeah,
Yeah.
you double dip. You can. Because that's a different calculation versus this.
That's probably one of the reasons it's important.
Okay? All right. So here it is. You have to do this. Oh, yeah. The other thing is make sure you have copies of your journal every year, especially that page that talks about the housing exclusion.
Is that journal available online?
Yes,
Yes.
or you can call Jenny or myself and we'll get you
That page.
the page.
Is there a specific?
The
website?
page.
Yes, that page.
Do you need it for the current year? Is that-
I suggest you do, because when you get to audit it, it's for the year. And if you have an exclusion that's 10 years old, the IRS might not look at that and say, well, that's 10 years old. So if you have every year a housing allowance exclusion, you got your records in order. okay? Yeah, you just make sure you're, secure in the sense that, yeah.
If I may. Okay, the Conference Journal we can get online. Okay, I just received like 2 weeks ago my 2013 Conference Journal. I'm going to assume that in the electronic version, I can get that from you a whole lot quicker than the printed one.
We know, we've been having retirees call us since the first of the year.
Okay.
Because they're.
When they're doing their taxes.
Good,
And
thank
we
you.
provided them with that page.
Thank you.
What section is it in usually?
It is under clergy support team report, so it's in the report section. Or it might be under the policies and procedures. It's the clergy support team, so we're for clergy support team, under that. We have to publish it in the journal every year, and it has to be approved at annual conference every year.
Okay. Moving on to beneficiary designation. You have your forms. You can complete your whoever your contingent annuitant is. And then you have also your beneficiary form. There's also a beneficiary form in your packet. I mentioned earlier, you can do different beneficiaries for each of the plans. You've got different plans, so you can designate that. If you designate someone else other than your spouse has to agree to it. And she has to know what she's doing, okay? Because I've had past spouses call us and call our office upon the death of a clergy and wondering where their money is, and we say it went to the children. So, okay, update this beneficiary forms when there's a change. The experience that we've had, Trudy and I's experience, is, you're the clergy, you did all your paperwork perfect, and then you pass away. Now you have a surviving spouse. The surviving spouse gets the benefit that you chose for her. She moves away from Missouri, goes to Virginia, but she never completes another beneficiary form. So now when she passes away, we have an issue of who's the designated beneficiary of the surviving spouse. So my suggestion, please, is that make sure that if something happens, you have a designation of beneficiary form in your financial papers, so we know who's going to be the beneficiary in case you don't submit it. Also, tell your family that you do have a death benefit. So if there's a death in the family, they call Trudy's office right away. Because the circumstances has been wherein Virginia calls us to say, we have a surviving spouse here from Missouri. And then I have to call Missouri and say, we have the surviving spouse of yours in Missouri that passed away. Now she has to look at the records to say, where are the forms? So always keep your beneficiary forms up to date, okay? The first one is important. The beneficiary forms will supersede any will provisions. So even though you have a will, if your beneficiary is outdated, we will still give that benefit to the information that we have earlier. Okay, and I've had situations wherein the beneficiary that was designated before had passed away, and then the clergy passes away. Now there's like, okay, we have to redo this check because instead of 2 beneficiaries, only 1 now. So always be aware that beneficiary forms are very important whenever there's a change in the life of the person, death, marriage, divorce, or death. Okay. We've done this. We've done the application form. July 1st is the first of the future, unless you designate the future date. The percentage to annuitant, meaning your spouse, or usually it's the spouse unless you're single. Contingent annuitant may affect the benefit. The younger your contingent annuitant is, the lesser benefit you get, because it's based on age. Choice of lump sum versus installment plans. We talked about the lifetime retirement income, which is a very good plan for you to look into. Annual increases, and you can leave it on account until you're 70 and a half, or roll it over to UMPIP. Again, this is the dedicated retirement team. They're real people, and they are waiting for your calls in case you need help with your forms.
I have a question.
Sure.
You probably answered it. Are you taking the taxes out of these, or are we?
You have to look at the forms, because there's a withholding form in there, and there's a state income tax form in there, so you tell us.
Okay, so if we designate, you will take the taxes out?
Mm-hmm. Yeah.
You'll take care of the state taxes as well?
Yes, the form, as long as it's completed.
Okay.
Wait a minute.
Yeah, there's a state form.
There's a state form in there.
Yes, but if you look at the form, Missouri is not listed.
Okay, if Missouri is not listed, you have to read the form. I know, it just say that.
There's no provision for the state of Missouri to take it out from the I have one last question.
Yes.
about the UM. Let's say I choose to roll over 35% into the UMDIP and just leave that for a
Yep.
while. Do I need to fill out the,
Oh, you need to do the rollover, yeah.
so I'm rolling over into UMDIP, not an outside.
Okay, so, and then you're not touching UMPIP?
No,
Okay, then you don't send the,
but I don't have to send this form enough,
No.
because I don't want to tie myself down to
Yeah.
the date. That way I-
yeah, don't send the UMPIP form, because that means the account will still be there. Only the form that you're gonna, the 35%. Yeah.
And then I just, if I want something.
You have to call
Call
and,
the general board for a form, okay.
Yep.
Understand, thank you.
I have one more question. Chris, if you take the distribution, defined contribution distribution as a lump sum, when is that payable?
that's payable at the date you want it.
Well, I mean, what dates?
Dates? Yeah, if you want
July
to,
1?
July 1, beyond July 1. You can't get it before July 1.
Okay, what I'm saying is, would it come in about the same time as?
Yes.
So probably in August.
No, we always get the checks out by July. Always. Always within the month of July.
Since you're a little longer, what was going to take till August?
Might be the last day of July.
Unless, okay, if you need the money for a deposit in the house, if you need that for something like that, you need to tell us right away. So that, no, if it's just, we will give it to you at the same time as the distribution of your other checks.
So in other words, I'm just trying to make sure I understood this. If everything adds up and you know what your bottom line is, with the exception of 35%, and determine how you're going to use that, that check would come sometime during the month of.
Yes, during the month of July.
Because I'm trying to set money back aside right now for the fact that I don't think I'm going to have income for a while.
Okay.
But I'm going to have bills due.
Yes, I understand that, yeah.
I couldn't make this anymore.
It doesn't work? Oh,
No, it's a shame because it's really helpful. It's a great piece.
it's a great piece.
Yes, it is.
I have one other question. I've had trouble getting into this system. I've been sent 2 codes, I've answered the questions, I have everything written down. I got into it once and I've been turned out every other time since then.
Okay. Can you call the retirement team, the numbers in there, and they will assist you in that one?
Okay, thank you.
Okay. Have I answered your questions?
I think you've done a great job.
Wonderful, thank you.
You're welcome. So your questions have been answered? Every question?
Yeah.
See?
Thank you very much.
Okay, well, thank you for coming, and happy retirement to everybody. And good luck on how you want to, when you complete your forms. Make sure it's the right decision.